Welcome back to the Prescribing Prosperity podcast with your hosts, John and Alex Soutsos. Gentlemen, we were in the middle of a discussion before time interrupted us last time. We were talking about the 10 most common mistakes that people make with their money and investing. And we'd gone through 5 of them. And we left by saying, when we come back, we're going to talk about real estate. There are lots of things to say about real estate. I don't know where you want to start or which one of you want to take this one.
We want to talk people off the ledge.
So,
good luck with that, John.
Let's start with the common myth that we hear all the time, which is your house is your best investment.
I don't know if it's the best investment. I don't know if it's the best investment, but I know for a lot of people it's their biggest investment.
Yeah.
Mm-hmm. And that in of itself is a problem. So your house is your best investment. Well, your house is where you live. Yes. I caution people against viewing it as an investment, although it is. And I don't want to discredit the fact that it doesn't appreciate in value, because obviously it does. But you need to understand that your house is where you live, mm-hmm. and it is providing you with a utilitarian function. And at some point, okay, so you sell your house, you still got to live somewhere, which is going to cost you money. So you can't just look at it and say, okay, net of my mortgage, I've got $100,000 of equity. Because if you sell your house and you got to turn around and buy something else, that money's still going to be tied up inside another home, or a portion of it is likely to be tied up still in another home. And so the idea that it is your best investment is a bit of a myth, and also because people look at it and they say, and this was a common refrain in the Canadian real estate market, is the real estate market always goes up, which is flat out wrong.
That one's here too. That one's here too.
And I would, to those people who believe that is true, I would tell you to go look at some current data relating to what the real estate prices are now relative to 18 months ago or 3 years ago. The peak was in Canada was around 2022. So just before I bought. So I am just pre-peak, but really expensive.
And just to refresh people's minds, there was a huge recession from 1990 to 1991 that brought down real estate prices dramatically in Canada and the U.S., and not to mention in the U.S., the great financial crisis of 2008 to 2009. So real estate does not go up into perpetuity year after year after year. It goes up over time. And that's good. But it's important to understand that it's not a perfect investment.
Yeah. And that's just it. A lot of people, what they like about real estate, and I know we've mentioned this before, but it bears mentioning again, they love real estate because it is something tangible. They can see it, they can feel it, they can understand it. And if you're somebody who comes from a background of not necessarily understanding the financial markets, or you're not financially nuanced in how the markets work, some people have this perception that the financial markets are just gambling, which is not the case at all.
Well, it's not just that, Alexander. Here in Canada, especially in the last 10, 11 years, we've had a large flux of immigrants from parts of the world that do not have advanced and developed capital markets or trustworthy capital markets. And so their default is real estate because that's how it's done in the old country. Mm-hmm. And so they need to make a psychological adjustment when they come to North America with the advanced capital markets, that there are other avenues for wealth building beyond just holding real property. And one of the people we spoke with recently happened to be a doctor from one of those from that part of the world. And he was buying real estate here, waiting 2-3 years, appreciating in value, then taking out the built-in equity and buying more real estate. And now he's on this treadmill where he's constantly doing this. And now he's upping out 10 properties. Now he's not focused on being a medical professional. Now he's focused on being a real estate magnate. And he's not doing his own job effectively, potentially. But then what happens when the music stops, like right now?
Yeah.
Now you're in trouble.
And that's and what he just said there, and I think it bears emphasizing, is you end up on this hamster wheel. And we see it a lot with the medical professionals because they have a high rate of income. The banks are willing to extend credit to them at a higher rate or in a greater capacity than they would the average person coming in off the street. And so they're able to leverage that higher income into borrowing and investing money into a house. And then, they build up some equity in that home, and then they borrow against that to invest in the next one and the next one and the next one. And then, they're renting out some of these homes to generate cash flow. But your time is already greatly constrained as a medical professional, and this isn't limited to them. I'm just using them as an example.
Yeah.
As any individual is, but they have a large amount of their time that they're dedicating to their craft, and that's required of them to educate themselves and stay up to date on the latest research and information. And to then take your limited free time and then now have to dedicate that towards being a landlord is a very inefficient use of your time. And the actual people don't actually quantify the cost of their time very well.
No, they don't actually. No,
they're terrible at it. They think, I can do it myself. Okay, you can. Should you? If your time is worth $500 an hour based on what you earn, and it costs $100 an hour to hire somebody to come in and do that job for you, why on earth would you ever do that yourself when you could bank the difference between those two costs by investing your time in something that is more productive for you? And that's part of the issue here that we see with these people. So going back to the medical professionals and other people who do this, they get stuck on the hamster wheel of, I need to keep making money so I can afford to make the payments on these homes, and then I can afford to buy another one, so then I can rent it out and get some cash flow, and then go out and use that cash flow to buy another property and another property and another property. And where does it stop? Where is the end game? Because at the end of the day, all your money is highly correlated because it's all invested in one market. We talked about diversification earlier.
Yeah.
And you don't need to over diversify, but you do need some degree of diversification. And if all you're doing is holding real estate, then you're not diversifying at all. You're entirely concentrated in one sector. And if you're a lot of people tend to invest in homes that are in their immediate neighborhood. So you're not even just in one sector, you're in one area of one sector. So if you're living in the Greater Toronto area, you are entirely tied to the ups and downs of the GTA real estate market. And so if that, like my dad said, if that market goes into the toilet for a period of time, and all of a sudden you need to access your capital for whatever reason, what do? We talk to people all the time. They're real estate or asset rich, but cash poor.
Yep.
They cannot afford to pay their expenses on a month-to-month basis. They're struggling. And you look at them and you say, look at your job. Look at the amount of income that you're bringing in on a monthly basis. You should have no problem covering all of your expenses, but it's because they have over-leveraged themselves in the real estate market that they have no liquid cash flow available for their discretionary purchases. And therefore, when it comes time for them to say, you know what, I actually do need to get rid of some of this because this is not productive for me, they can't, because the market is illiquid, it's slow moving, and it takes time for them to actually get that money out of the house. And they don't want to sell at the bottom of the market because they won't look at the opportunity cost of saying, I could have this money invested somewhere else. All they can focus on is, I sunk X amount of money into it, and until I get X plus Y out of it, I'm not selling. Which is irrational.
Yeah. Well, real estate, just to drive home a point you're making, is a very, 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 very different kind of investment from like stocks, bonds, or alternative investments, right? Yeah. Because one, it's tangible. Two, you typically, you live in it. You can see it. You can feel it, right? But then if you're building a portfolio of real estate, you now have real, tangible, physical assets that demand your time, they demand your attention, and they
demand maintenance.
They demand your cost. They're very different. Stocks don't have any of those. Stocks, bonds, whatever, don't have any of those requirements.
I need to distinguish here because there are a lot of successful people in the world who've achieved that success through ownership of real estate. So I need to distinguish between passively investing in residential completed housing versus people who are in the business of real estate, which is to acquire raw land, put in services, build on that land, and then sell it to the end user, or people who will buy a home that has been poorly looked after, update it, and then sell it at market value. That's the business of real estate, and that is
Yes.
vastly different
Yes.
than a person who just simply buys a house and rents it out casually.
Yep.
And what we're referring to are the people who have other full-time jobs and are trying to manage this passive ownership of real estate. And it's very time consuming. It's a pain in the rear end, because if anything goes wrong, it's your name on the list that gets called. Now, looking at financial assets like stocks and bonds, they're not, if you hire someone like us, then they become passive. But same argument as real estate, if you're going to do it yourself, you're going to try and trade stocks on your own, good luck. You can't do a professional job at whatever your career is effectively and try and manage a stock portfolio. The fact that you can buy and sell stocks doesn't mean you're good at it. Okay, and there's a big distinguishing feature here. The investment arena is an arena that anyone can participate in.
Yes.
You don't require any expertise whatsoever. You just need the ability to open an account and have some money to invest. But the fact that you can do it doesn't mean you're going to do it as effectively as someone who is a professional like us. And most people, when I say most people, I'd say 99.9% of people should probably keep themselves out of the process of investing in the financial markets, because their emotions are going to get in the way, and they're going to make bad decisions that can result in catastrophic, not marginal losses, catastrophic losses.
And just to put a bow on it before we move on to the next mistake that people make, one thing that I think is worth repeating, even though we've discussed it again before, is, what portion of your assets should be held in real estate. And I think a healthy ratio is about 40 to 50% should be in real estate, and no more than that. And the remainder should be in a stock and bond model, ideally, in our opinion, stock.
What Alexander's referring to is your principal residence should account for no more than half of your assets.
Yeah.
That doesn't mean you can't own a second or third property. You can, but just understand what you're doing. You're being highly concentrated, and you're taking time away, and all the other things we discussed.
Listen, you can get a second property. But sorry, Bill, I was just going to say, you can get a second or third property, but I would discourage people from doing that until they've accumulated enough on the other side of the ledger with their stock portfolio before they start allocating more into the real estate side of the ledger. Sorry, Bill, go ahead.
No. What I was going to say is actually this topic really introduces us really easily into the next topic. And it goes back to something that John was saying in terms of most people overwhelmingly probably shouldn't be managing their own portfolios because they're too emotional. And too emotional can lead to doing things like chasing headlines, right, guys? In the States, in the States, the meme stocks and what have you. But there's always a fresh piece of meat that everybody wants to get a piece of.
Yes. One of the examples that I love to give in this arena is when I was a kid growing up, thinking about 8 or 9 years old, growing up in Mississauga. I played hockey, and I at the time I was playing at in Meadowvale. And I remember standing in the hallway at Meadowvale Arena, the smell of the cheap 40-year-old hot dogs and French fries in the background, and gasoline from the Zamboni. And all you could, and some of the parrots who smelled like the night before. But we'd be standing out in the hallway, and everybody and their cousin was talking about, I've got to own a Tim Hortons franchise. I got to own a piece of Tim Hortons. And you got to remember, at this time, we're talking, mid to late 90s. This is when Tim Hortons was starting to really explode and take off as a company. And I remember thinking at that time, and my dad actually ended up telling it to me on the car ride home. He goes, that's how we know it's over. That's how you know the ride is over. When everybody else is talking about it, that means that it's already reached its peak and it's time to get out. The node has reached, optimum capacity. And now everybody else is they're scrambling to come after the scraps. And all that's going to happen is the price is going to start to come down, because the people who actually understand the business are going to look at it and say the value does not justify the price anymore, and they're going to start looking for the next opportunity to invest their money.
Yeah, no, I mean, it is interesting because in the States, and John, you see this as a portfolio manager, there are always it stocks. There are always it stocks.
Like SpaceX?
Like maybe SpaceX. Yeah. Yeah.
And by the way, it's down 20% from 2 days ago.
Yeah.
Yeah.
Listen, I get this question all the time, and I know my dad does too. People always ask us, what stocks are you recommending? And the problem with that question is, we don't. That's the way, and maybe it's our perspective being inside the financial services industry. But we don't look at it as what's the it stock. We're not looking for that. All we're looking for is where's the next opportunity for the next. It doesn't. We don't even have a defined time horizon. We want to find what's running now. We want to capture it while it's running well, and when it's not, we're out. And so when people say, "What are you looking at?" We're looking at a lot of different things, and just because we like it today doesn't mean we like it tomorrow. And so I really hate when I get that question.
My new answer is my portfolio.
I know that's always been your answer. It's not new.
Okay, so what should I be looking at? My portfolio.
I know
because here's the problem. It happens on all the talking heads on TV as well, like Kramer in the U.S. and BNN, Bloomberg here in Canada. And that is, they bring in a portfolio manager, high profile, and they say, "Oh, what 3 stocks are you recommending right now?" Well, why in the world would you accept a recommendation on television from a guy whose motivation you don't know why he's recommending that stock? He could be in the process of liquidating that stock, and he wants to get a better price. So he's saying, "Yeah, I like ABC, DEF, and XYZ." XYZ is for you American people, and that's why he's recommending it, right? And you don't know what the motivation is, so don't take advice from people on TV about what stocks to buy or what stocks to sell, because it is not necessarily prudent. And not only that, they'll never see you again. Or you may never see them again. They're not going to call you up and say, "Oh, by the way, when I was on TV 3 weeks ago and I said buy these 3 stocks, I'm selling those now, by the way." Right? No one does that. So and
just to also add on to that, in terms of the going back to like the chasing headlines idea, which is what this umbrella is that we're talking about right now. If you end up just chasing whatever somebody recommends to you, you're constantly going to be making these knee-jerk reactions that are not founded in any sort of sound structural framework when it comes to making in order to having a defined, rigorous investment process like we are. And the other thing is that we see is, people get caught up in the macroeconomic headlines. And so all they end up doing is not only yo-yoing their own emotions, but they end up yo-yoing their investment decisions because they're buying in when the price is really high. They sell when the price is low because they want to get into the next thing, or they sell because everybody's told them the sky is falling, you need to get out. And so they end up making these really poor decisions. I keep getting people who are asking me, when's the crash coming? And I like literally just yesterday on the golf course. And I looked up and I was like, oh my God, are we still having this conversation? And, everybody's losing their shirt over what's going on in macroeconomic news and in the news in general. And, what's Trump doing and what's happening in the war and blah, 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 what's happening in the tech market. And what ends up happening is people are making decisions based on their emotions and rather than on, like I said, sound intellectual framework for investing. And that creates problems.
Well, you know what? And that segues into one of the next points. And there's one I'm going to come back to. But you were talking about biases. You were talking about people. When's the crash going to come? These are things that are recency biased. To kind of, So talk a little bit about biases, because if you are doing your own trading and you're susceptible to chasing headlines, your judgment is also suspect by forces that you probably don't even recognize.
I think this is a good place to discuss mental accounting. Alexander, perhaps you can relay the story you have about that.
Yeah, this is there's a number of different biases we're going to cover here, but one of the things that I recently encountered was somebody I know who's very important to me was talking about their investment portfolios, and they're talking about, their TFSA versus their RSP and their non-registered account, and how they have their money invested differently in each of those accounts. And I tried to explain to them that that is an irrational process. It is still your money. It is like saying, the money in my left pocket's for spending, the money in my right pocket is for savings. Or if anybody's a fan of The Office, if you remember when Michael goes on his business trip to Winnipeg, which I don't know why anybody would want to go to Winnipeg, but which is
Hey, we
makes
have
it all the
clients in
funnier.
Winnipeg.
Okay, well, apologies to them. They can come fight me. The point of what what I'm trying to say here. So he's going on this trip and he gets his per diem, which is supposed to cover his food expenses. And he says to the guy, "I'm going to buy a sweater with this money." He goes, "Michael, you don't understand that's your per diem. That's your money for food." He goes, "Oh no, I'm going to use different money for that." But that's the way people think. They think about it as, instead of saying, I've got $20 here and $20 here, I have $40. They go, "Oh, I've got $20 for this account and $20 for this account."
Yeah.
And therefore I need to treat these two accounts differently. And so the person I was speaking with was telling me about their TFSA, and they said, "Well, I put my risky stuff in my RSP, which is the IRA for you American listeners, and the Canadian equivalent of the IRA. And my TFSA I use for my non-risky stuff, because it's basically my emergency cash that I have on hand in case something goes wrong." So this individual they got laid off from their job last year, has been on paid leave for the last almost 18 months, and is now approaching the end of that paid leave and is looking to find a new job. And they're thinking about it in terms of, what happens the next time I get laid off? Well, first of all, you should have an optimist mindset and think, I'm not going to get laid off again. But setting that aside, because that's a separate discussion, in terms of your money in these accounts, the way they were looking at it was, I need to have this TFSA or the Roth IRA as my safety net, because I can pull that money out tax free if I need to spend money, if I need to cover my expenses on a month to month basis. And what I explained was, that's the worst thing you should be doing. That account has, basically, you have unlimited upside, because there is no capital gains tax whatsoever on the growth that happens in that account. So if anything, you should be taking your biggest home run cuts inside the TFSA or the Roth IRA in the United States. And for somebody to then to sit there and say, I'm going to treat it like a checking account, is nonsensical. And I explained that to him. I said, look, you have a line of credit. One thing we touched upon in the previous episode when we talked about cash. In the event that something goes wrong, you've got a line of credit on your house that you can dip into. Are you going to remain unemployed for an eternity? Probably not. So I wouldn't worry about how much you're going to run up on that line of credit. It's probably at worst going to be, anywhere between $10,000 and $15,000, which is a very manageable amount of debt.
The lesson of all of this is that money is fungible.
Yes.
Okay, so it doesn't matter. Mental accounting is not a good exercise to go through, saying this is for Susie's birthday gift, and this money is for that. It's all one account. It's all your money. And
it's all money.
When you distribute that money, it gets distributed. The fact that you reached into your left or right pocket doesn't make a difference whatsoever. Money should be at all times invested in a very productive fashion, and it's a very important financial planning tool to understand.
And it needs to have a coherent plan. You have to have a coherent thesis with what your goal is, because if you are trying to service 5 different masters, you want to suck and blow at the same time, you're never going to get anywhere. You got to actually come up with a defined plan. This is what my goal is. My goal is to grow my money to the maximum degree possible, and then do everything you can to achieve that goal. If you start throwing on, but this account is this, and this account has to be this, you're throwing in unnecessary obstacles that are going to impede you from reaching your financial destination. So anyway, Dad, do you want to talk about some of the other biases that investors experience? Bill threw out familiarity bias or recency bias. Those are 2 good ones I think that you should start with.
Well, familiarity bias is very common. One of the most common experiences of familiarity bias is people who make investment decisions in individuals' companies. So anyone who works for a company that has publicly traded shares, let's say the banks, for example, here in Canada, or whatever company in the US, you're giving your equity to your employer. You should not give your financial equity to your employer. There's nothing wrong with putting a small percentage into your employer's stock, but you better make sure that the quality of that company in terms of its financial metrics, return on equity, return on invested capital, profit margin, all that, that has to be right first. The fact that you're familiar with the company or you work for the company is not sufficient justification to invest in it. And it reminds me of a story I had with a client who used to work for an aerospace company here in Canada. And he had 80% of his money tied up in that company. And when I warned him about that a risk, he basically responded in his familiarity bias explanation saying, I know the company's order books. I see all the orders coming down the road. If anything is going to happen that's going to go wrong, I'm going to see it before anyone else sees it. I can make a trade on my computer instantly, blah, blah, blah. And I gave him all sorts of reasons why that wasn't a good idea. And within maybe 12 months of that conversation, 9/11 happened, and their order books for airplanes fell off a cliff in a single day. So things can change very rapidly in the capital markets, and the fact that you're familiar with it. And another popular one here in Canada is Bell Canada, or in the States, the AT&T. Everyone at some point, especially people of our generation, Bill, we all grew up with these large telecommunications companies as utilities and dividend payers, and people still think that you can buy these stocks and hold them forever and you'll be fine. Except if anyone's taken a look at what has happened to Bell Canada shares here in the last 10 years, or for that matter, take a look at AT&T shares.
I was going to say, look at AT&T shares.
Or Verizon for that matter. These are not...
How about Sears? How about Sears? Sears was a blue chip stock for decades.
But I'm talking about
where's Sears now?
now.
I know, but I'm just saying in general.
Yeah, but we used to call these things widow and orphan stocks because they paid a dividend. And people thought they could just simply buy a handful of these companies, live off the dividend checks, and they'll be fine. That's not true anymore. And so the fact that you're familiar with AT&T or Bell is not sufficient reasoning for investing in a company. And that speaks to familiarity bias.
So, and recency bias is the overemphasizing of recent events to explain the near future rather than placing information into a historical context. And so, as I mentioned earlier when I talked about what was going on with the possibility of a tech crash, or what's going on with the Iran conflict with the United States and Israel, and people, because it's fresh in their minds, they project it into the future and say, well, this is the current reality, therefore it's going to be the reality into perpetuity, which is not the case. And unfortunately, and this is something that affects all of us, we have a tendency to overemphasize those things that have happened most recently and place undue value and likelihood in their occurrence in the future. And that results in us making decisions that are not necessarily optimal. And that's where you need the benefit of somebody with an objective ability to analyze companies, analyze the markets, analyze market conditions, and make that determination. The people I was golfing with yesterday, they assumed that the stock market was bad and we shouldn't be investing in the stock market because they don't like who's running the country in the South. Well, like him or not, the personality is not really material or relevant. What's relevant is the investment environment that he's created. And the investment environment is extremely conducive for companies increasing their earnings, which is what stock values are based on. It's based on earnings.
Well,
and so
supposedly.
if companies have, and so if companies have the ability to grow and increase their earnings at a much greater capacity than they have in the past, then they should theoretically continue to do so. What is happening outside of that is not really relevant. It's just noise. So that's one of
that's the important thing about geopolitics is its noise. And it is very critically important for investors to understand that geopolitics is noise. It's temporary noise. And a year from now, there'll be different geopolitical noise. And 5 years from now, there'll be different geopolitical noise. And if you're focused on geopolitical noise for your investment decisions, you will be frozen into inaction and you'll never invest and you'll never achieve your objectives. So ignore the geopolitical noise.
And one thing I want to do just before we move off of the behavioral biases, there's two more here that I think are really important to mention. One is regret aversion. People are always afraid of making the wrong decision. And so in the absence of making the wrong decision, they will make no decision, which unfortunately creates what we call opportunity cost. And that is the benefit that you have foregone by refusing to make a choice. And we've seen it in significant, unfortunate capacity with some of our prospective clients who have refused to make a move, and we're talking about in the tens of millions of dollars of money left on the table because they refused to make a decision. And so that's one issue. The other one is inertia or status quo bias, and that one is when faced with new information or a wide variety of options, investors often choose to keep things the same, and thus, as I just mentioned, they create an opportunity cost from missing out on the better investment strategies. And that ties back into what I was saying about the houses. I don't want to sell my house at a loss. And actually, the same individual who I was referring to with treating their money differently in different accounts, their spouse is facing this issue where they have money tied up in an investment property, a real estate property that they use for investment purposes, that has significantly declined in value. The rent has also gone down, so they're not even covering their mortgage payments now with the rent money that's coming in. But they don't want to sell because they can't stomach the idea of selling it below a certain price. And what I was explaining was that it's not only is that obscenely irrational, but you are leaving money on the table because although you may have to take a loss on that piece of real estate, that money could be invested somewhere where it's working productively for you. So while the real estate market isn't moving, the stock market is. And so rather than just leaving your money sitting on the sidelines, doing nothing, or actually going backwards, take it out now, take your medicine, and put it somewhere where it's actually going to start moving forward for you.
This is akin to being on a bus that breaks down, and the bus driver says, "We've called a mechanic and he'll be here in a couple hours." And there are other buses running on this route, so you can just get off and
get on those buses. Yeah.
No, I'm going to sit on this bus.
Yeah. I've already invested this much time. It might change now. As soon as I get off, it's going to start moving again.
Yeah. I don't want to. And it is an irrational behavior, and that's an oversimplification, of course. That's effectively what people are saying with things like residential investment in real estate, or investment in residential real estate, is they're saying, I've lost money now. I don't want to realize the loss because I'm going to feel bad about it. And so I'll just stay here until the real estate market recovers. But the real estate market may take 3, 4, 5 years to get back to where it used to be, or maybe 10 years. Mm-hmm. In the meanwhile, capital markets are moving. And we use terms like the stock market. We're not saying a passive investment in the stock market. We're discussing about a well thought out, tight, well structured, and actively managed investment portfolio, because just investing in the market is not sufficient.
Yeah. So, Bill, where do you want to take it from here in terms of because we got two more to cover.
I know we got two more to cover, and we've talked about the accumulation of wealth a lot. When you are accumulating wealth, a couple of things need to happen. One is estate planning. Do you see people reluctant to be active in their estate plans, or what kind of behavior are you seeing from clients there?
I do. I see a lot of people who are afraid of the topic, and this is not even just limited to my experience professionally, but even in my personal life.
Sure.
I've seen it. There are certain members of our extended family who they feel very uncomfortable talking about what happens at the end, what's going to happen next.
Well, that's a lot of people. That is a lot of people in my experience.
And I can understand to a certain extent that it's an uncomfortable discussion to have, but the reality of it is every single one of us is going to die at some point. And so what we are doing is we are planning so that when that eventuality occurs, things happen in a very methodical and orderly fashion in order to minimize the stress that gets placed on whomever is responsible for handling the fallout from that event occurring. Dad, do you want to chime in on that?
No, carry on.
a lot of people, they find the topic off-putting. It's not exciting. It's not fun. Listen, I understand talking about, the growth of your money is a lot more interesting, and people want to discuss that, because it's a more positive outcome, and they can think about all the things that they're going to do with their money.
Yeah.
The idea of dying is morose and depressing, but as I mentioned, it's an eventuality.
There is estate planning for some people is a very difficult subject matter, but for others it's not a difficult subject matter, and they are very proactive. One of the issues that we come across here in Canada is the registered plan. Initially, as you're accumulating, it's called a registered retirement savings plan. And as you're deaccumulating, it changes at age 71, 72 to a registered retirement income fund.
Yeah.
And there's a bunch of people in the investment industry who are promoting this idea of RIF meltdown. In other words, because what happens is when you die, if you still have money in your registered plan, the entirety of that plan, if it's $1 million, becomes income in the year of death, and you can, in today's Canada, slice off 55%, give it to the federal government.
Wow.
Or combination federal provincial government. And people don't want to do that. So they're saying, I want to melt down my RIF and, give the money to my adult kids while they can still use it while they're young enough, and blah, blah, blah. Well, that's all fine and dandy, except all you're doing is accelerating the tax liability.
Yeah.
So instead of your estate paying the tax, you're paying the tax now while you're alive. And so recently we had a discussion with someone who wants to help their kids buy a house. Okay, well, they can borrow money from the bank at 5% or less to buy a house. I think a 3-year mortgage is like 4% or something. And
3.89.
Yeah, let's call it 4. So 4%. Meanwhile, the cost of pulling money out of your registered plan is 54%. So, what's cheaper? Obviously, it's cheaper to borrow from the bank. So
plus your rate of return. You have to factor your rate of return in there too.
That's exactly. Or for that matter, for buying a car, same issue. So the RIF meltdown. Now there is other people who are actively promoting. Well, if you borrow a lot of money and the interest expense on the borrowed money goes into an investment vehicle, you can offset the income from the registered plan to allow you to melt down your RIF. Well, the amount of money you would have to borrow to make that a viable strategy at an interest rate of 4 or 5% is absolutely massive. And it is not advisable to be doing something like that. And the vast majority of people simply don't have the psychological comfort to borrow a massive amount of money so they can melt down their RIF.
Sure.
So these are all, and then you get into tax shelters and stuff that is higher risk. So RIF meltdown strategies, for those of you listening in Canada, not a viable strategy. Another client said, well, I'm 65. I'm going to have to take money out of the RIF at 72. So let's melt it down now. Well, okay. So you melt it down. You're going to spread out $2 million or $3 million over 5 years. Your tax bill is going to be horrendous. You're not doing anything. In fact, the number one guidance from any tax specialist is deferral. Defer taxes as long as you can, because you're hoping at some point in the future, some sane human being will take over the government and lower marginal tax rates. And although we don't see that happening anytime soon in this country, it could still happen regardless of what we think.
Yeah.
All right. Do estate planning. Don't make the mistake of not doing estate planning, because yes, we are mortal and nobody gets out of here alive. Okay. Now, I think the last topic is the biggest topic, and not because it's the most difficult one, but I think it's from a sense of tough. It's just that lots of people don't want to retire, or they're not sure when to retire. And so they tend to think of retirement as an age, because they go, I'm going to retire at age 70, as opposed to looking at it in other ways. Talk about the myths surrounding this one, guys.
Well, I when I began my career, all we ever talked about was retirement. You got to save for retirement. And that's because it was a different paradigm in the 20th century when I began. It sounds like a long time ago.
I like that, though. It does.
So in the late 60s, early 70s, people were typically what would happen in the 20th century, especially the mid 20th century, is young guys or ladies would come out of high school, and get a job. And they would work for the same company or organization for their lifetime. And then at age 65, they got the retirement party with a gold watch, and they went off to the sunset, had a heart attack 2 years later. And that was it. And that was life in the mid 20th century. Now, as we all know, all of that changed, and pensions don't even exist anymore unless you're a government employee. Other than that, pensions don't exist. They're all essentially group RSPs or 401k plans in the U.S. And so the money is going to get you as far as you can grow it based on your own decision making. And so, especially people of our generation, Bill, many of us, including myself, we don't want to retire. But what we do want is financial independence. And so it's not about retirement planning. It's not about retiring. It's about when do we want to have enough money that we can say, I'm going to keep doing this because I still enjoy it. But at some point, I might decide I want to do it for half a day or half a week or once a month or not at all. Right. And having the financial independence in your back pocket, knowing that you have enough money that you can pull the plug at any point, is really the ultimate objective, is financial independence. And so there is no age attached to that. If you can achieve financial independence at 40, that's the goal. If you can do it at 55, that's the goal. But the sooner the later, sorry, the sooner the better, the sooner the better. And this is why prudent investment management makes sense. When I say prudent, I mean intelligent investment management. Everyone has been coddled into believing that institutional wealth management is the way to go, that your objectives, your investment program should be based on an expected rate of return of between 5 and 7% a year. And, at those rates of return, your money is not going to double for 12 to 15 years. And that, unless you're going to live to 200, that's not a good strategy for financial independence. So the strategy for financial independence is to concentrate your assets into a small number of high quality businesses, whether that business is run by you, as many entrepreneurs, like Bill Gates was a businessman, Jeff Bezos a businessman, Warren Buffett, et cetera, et cetera. These are all entrepreneurs. And they created one business. All their money, 100% of the money was in one business. It wasn't in 50, right? So that's how you create wealth. Now, if you're not capable or interested in going down that path, then you find other successful businesses that you can buy a piece of. And that's what happens with stocks, is you can buy a piece of a successful business, but you're not going to achieve financial independence by owning 500 businesses, because likely there aren't 500 really successful businesses anyway on the market. So you need to concentrate into a smaller number of high quality businesses, 20 to 30. And you need to hire a professional like us who's going to manage those businesses on your behalf and achieve rates of return significantly above 5 to 7% a year. So you can acquire your financial independence earlier. And a very quick anecdote. August 1st of last year, we took on a new client who said, I need to double my money to get to my financial independence number, which is X. And so we invested his money, and we happen to have a fantastic year in our portfolio this year. And I called him up recently, and the money hasn't even been there a year. It's been there 10 months. I said, you're there. What? You're there. He says, I thought we're going to do this over 10 years. I said, well, we can, or would you rather be there now? Well, I'd rather be, well, you're here. You've arrived. So, what are you doing, John? Are you gambling? No, we're not gambling. We're investing appropriately in high quality businesses whose business is doing really well right now. And when that finishes, we take our profits and we move the profits elsewhere. And through prudent investment management, we have been able to achieve financial independence. This last 12 months, and mostly people around my age or within plus or minus 5 years of my age, I think I've retired more people in the last 12 months when I say retired, I've helped people achieve their financial
There
independence
you go.
goal. More people achieve that goal in the last 12 months than at any other time in my career. And that has to do with the uniqueness and the exceptional achievement of our investment strategies. And we encourage everyone to reach out and learn more.
Yeah. So do that. Reach out to these guys and do that. Can't guarantee that, John's going to double your money in 10 months, but that's a cool story. And I love that. And John has a impressive track record over the last several years, and you can look up his investment track record, right, John? It's on your website. And
Yes. Well, we have a weekly newsletter called the MedWealth Weekly Market Brief. Anyone who sends us their email address will get onto that. And on the MedWealth Market Brief, our track record
there you go.
is identified in that newsletter. We also have regular webinars that we broadcast to both prospects and existing clients. Alexander is the go-to guy for all of this information. You can send an email to info@medwealth.ca. That's info@med-wealth.ca. And you can get all the information you need. And by the way, 4th year running, we've achieved portfolio, one of the top 10 portfolio manager of the year awards here in Canada. And that's more than just performance. It's also about overall service. So we're one of the top 10 wealth management services in the entire country for the 4th year running. So we're very proud of that achievement. But in an objective metric where we're not looking at subjectivity, our portfolio has been the best performing track record in North America in the last 12 months and over the last 5 years. And we have the evidence to prove that.
And that's great. And it's good if you win it once, but what's really impressive, guys, is if you win it 4 years in a row. That's sharp. So do reach out. Do get a hold of them. Go to their website, sign up for the newsletter, and get in touch with these folks at MedWealth Financial. It's a good, healthy thing for you to do. We've got to end this podcast now. But before we go away, Alex, the next podcast, we're going to continue to talk about financial planning. What would the subject be next time around?
Well, Bill, I initially had thought we were going to do a podcast where what would we do with if we were a 35-year-old professional starting from scratch today. We will do that one, but I think actually, given that we left off on retirement planning and getting to retirement, I think the next episode should be focused on that. So I think the next episode is going to be the retirement crisis that nobody's talking about. And we're going to be discussing what some of the issues that people experience going into retirement. And then the following episode will be discussing the financial plan that we will put forth for somebody who's a 35-year-old professional starting from scratch today, what they should do to get everything right.
All right. That's fantastic. And you won't tune in for that because I have a feeling that John and Alex are going to have a pie fight in the middle of that one. So be sure to be here for that. And the best way to ensure that you are is to hit the follow button and become a subscriber if you are not a subscriber already. The other thing I would ask is if you like this podcast, tell people about it. Give it a like. Let people know. Share it with them. Until next time, I'm Bill Tucker. On behalf of John, Alex, and everybody at MedWealth Financial, thank you for taking the time to tune in today. We'll catch you next time.
Thank you for listening to Prescribing Prosperity. Visit our website at med-wealth.ca. That's med-wealth.ca for more information or to connect with us for a consultation. Don't forget to click the follow button to be notified when new episodes become available. The information covered and posted represents the views and opinions of the hosts and their guests and does not necessarily represent the views or opinions of IPC Securities Corporation. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investment advice. Always seek the advice of a qualified and licensed financial service provider with any questions you may have regarding your investment or retirement planning. MedWealth Financial Services can provide a private consultation to help you determine the suitability of any guidance discussed on the show.